Here again with Smart System. In our last lesson, we looked at how the Fed is expected to react at different points in the business cycle and what market movements can be expected as a result. In today's lesson, we're going to look at how the Fed goes about signaling to the public changes in their thinking on monetary policy, so we can begin to understand how the markets react, not only to actual changes in the interest rates, but also to anticipated changes. So let's get started. While we simplified the situation in order to better understand the basics of how the Fed uses monetary policy. As you can probably tell by now, forecasting economic conditions and using monetary policy to try and manage those conditions is a very difficult process. The members of the FOMC are constantly analyzing economic data from across the country to try and gauge where the economy is in the business cycle and what, if any, monetary policy action is needed. As we've touched on in previous lessons, the FOMC has 8 regularly scheduled meetings throughout the year, where they meet to discuss current economic conditions and expectations of future conditions. It's at these meetings that decisions on what, if any, changes in monetary policy need to be made. Upon completion of these meetings, a press release is issued. As we've learned in previous lessons, what the FOMC decides at these meetings to do with their target for the Fed funds rate has wide ramifications for the economy, and therefore the markets. With this in mind, the results of these meetings are closely followed by market participants. It's important to understand, however, that the market not only looks for whether or not the FOMC takes action on the Fed funds rate, by how much, but also for any clues in the Fed statement as to what their bias may be for future interest rate decisions. This is a very key point to understand, because the markets are always trying to anticipate what is going to happen, and therefore they move up and down, depending on what people think will happen to rates going forward. Anything that comes out from this meeting, or anything else that is in line with what the market expects, should have little or no effect on market prices. Conversely, anything that comes out which changes the market's forecast on what, if any, Fed action will be, can cause drastic moves in the markets as participants react to this new information and markets adjust accordingly. The large volatility that can be caused when the market participants are caught off guard by change or lack thereof in the Fed funds rate is not a desirable outcome for anybody in the market, including the Federal Reserve. In order to try and prevent large moves which occur when the market is caught off guard, the Fed will always try to signal ahead of time what their stance is on interest rates, and more times than not, by the time the FOMC decision is released, the market has already priced in whatever action, if any, will be taken on the Fed funds rate. The 3 main ways that the Fed will signal its intentions to the market are: the first being the release of the policy decision after the FOMC meeting. While the announcement of what, if any, change in the Fed funds rate, their target for the Fed's fund rate, is obviously an important component of the release. Just as in many times, even more important on market moving is the accompanying statement, which normally includes the Fed's bias going forward. You can see that the bias going forward in this particular announcement is for the Fed to reduce interest rates. Although they say that inflation needs to be monitored, they also say they expect it to moderate. So this, from the inflation side, means that they aren't overly concerned with inflation or expecting inflation to inhibit them from being able to lower interest rates. In addition to this, they also come right out and say downside risks to growth remain, and that they will act as needed to address those risks. Very aggressive comments that they're going to potentially decrease rates. The second is the FOMC meeting minutes. These are the notes or minutes from the latest FOMC meeting, which are released 3 weeks after that meeting. These are much more detailed. This is a much more detailed account of what was discussed at the most recent FOMC meeting, and market participants will pore over every word of this release, looking for clues here, as well as to future policy action. The third is public speeches. Voting members of the FOMC will give speeches periodically, where they will discuss recent market events or economic events, and sometimes signal potential changes in their bias. These speeches, especially when made by the chairman of the Federal Reserve, who's their Fed's main voice, will also be closely monitored by market participants as well. So any of these three things, the Fed will use to sort of signal what they may potentially do with interest rates in the future. And there's lots of news sources out there: the Wall Street Journal, the New York Times business section, Investors Business Daily, and most sites that have any economic news, Yahoo Financing, etc., which will cover the release of the minutes and obviously the interest rate announcements and the speeches that are important and normally have commentary relating to that. So lastly, market participants will also closely monitor economic releases for any signals that the economy may be growing more or less than the market is currently expecting, or also the Fed is currently expecting, which also may change, and their current view on where monetary policy should be. There are few economic releases that are the most important and most market moving in this regard, and that's gonna be the topic of our next lesson. So we hope to see you then. As always, if you have any questions or comments, please feel free to leave them in the comment section. And good luck with your trading. Have a great day.